next financial crisis, banking stocks are slumping, recession, financial panic. In this video, I will tell you what the hell is going on, how this could happen, what does it mean for the future, and most importantly, how can you profit from this? How could the 26th biggest bank all of a sudden collapse? The second biggest bank failure in the history of the United States. For that, we need to go back to 2020. Interest rates were at its all-time lows, money was cheap, and the whole startup sector was booming. So it was very cheap for investors just to invest in startups. What would be the next Google? And all these startups needed a place to put their money. Silicon Valley Bank. So now here is Silicon Valley Bank with its newfound cash. And what do banks do with all this cash? They don't keep it at hand. In the States, we have something that we call fractional banking. Just as the word says, they just need to keep a fraction and the rest the bank will invest. This is what banks do. Now, then there's a question, why did Silicon Valley Bank still collapse? Well, it wanted to put their money in a safe place. So it decided to invest a ton of its assets in long-term bonds. So if they don't sell their bonds early, their profit is guaranteed. So if their profit is guaranteed, why the heck did Silicon Valley Bank collapse? Remember, 2022, inflation was coming. First the government said, nah, there's not real inflation. Then the government said, okay, it just temporarily. And then, damn, this is getting serious. We need to do something. And what does the government? It raises interest rates. And all of a sudden, oh damn it, investors started slowing down with their investments. Money became more expensive. Most of these startups, they run with negative cash flow. So they pay their staff, they pay everything based on the investments they received in the hope they will become eventually a profitable business. Now all this money was stored in Silicon Valley Bank. So because new investments were not coming in, these startups were just withdrawing money, pay for their expenses, to pay for their staff. A second thing that happens with high interest rates is the bonds that Silicon Valley bought become less and less valuable. Now the problem is, as these startups were withdrawing money, Silicon Valley Bank did not have cash at hand. So they needed to liquidate their assets. They needed to sell their bonds back to the market. Therefore, they had to sell them at a loss. And a loss of a few $billion. I will put now the exact amount on the screen because I forgot to put this in the script. When they had to release their earnings, they said, we just need to raise some additional capital of a few $1 billion. No biggie. But all of these startups were like, what the hell do you mean you made a loss? I thought my money was safe there and you made such a big loss. Keep in mind, the government guarantees that your money is safe up to $250,000. These startups in total had billions of funding in their bank, and they did not want their money to be gone. So what they all did, they ran to the bank, they grabbed all their money out, the more people ran to the bank. It's a classic bank run. And all in a few hours, it all came crashing down. Then the government said, oh no, if Silicon Bank is falling, who else will be next? If there's a bank run, and what the heck will be the consequences? What will be the ripple effect? We don't want the bank run. We need to do something now. So the government said a statement. Don't worry, Big Daddy is here to save you. No problem. Everybody gets their money back. All the other banks can just sell their bonds without a loss. Your money is safe. Shh, be quiet. Cheers to inflation. So why did this happen? Now, there are two biases in the human mind. It's the optimism bias and the normalcy bias. The optimistic bias says people overestimate the likelihood of positive events and underestimate the likelihood of negative events. Therefore, Silicon Valley Bank was making its portfolio. It did not consider or interest rates would rise. And the normalcy bias says that things will go on in the future as they normally do. It are normal human biases. Now you might be thinking, well, in banks like this, there should be like a chief risk manager that rebalances banks their portfolio in order that these things do not happen. Well, I will tell you one thing. For 9 months, between April 2022 and January 23, there was no chief risk management officer. The person who is responsible was just not there. It's like navigating a ship through a storm without a captain. Well, for sure it will capsize. Oh yeah, it did, surprise. Now then the third question is, what does it mean for the whole banking sector? Is your bank safe? Should you take a run for your money as well? The short answer is no. First of all, big banks are way more diversified. It's very unlikely that all sectors will collapse at once. Secondly, in 2010 was what Frank Law was passed. That means that gave big banks very strict regulations, so a financial crisis as in 2008 could not happen again. And now you might wonder, why the hell could Silicon Valley Bank fail? It's the 26th largest banks in the United States. It for sure must fall under that law. Well, it did. Up until 2018. In 2018, Silicon Valley Bank was lobbying to change this law. Every bank who had assets more than 50 billion fell under the Dodd-Frank law. But since Silicon Valley Bank, they're lobbying, it changed this threshold to $250 billion. This could have prevented their collapse. Obviously, there will be a whole investigation. New legislation will be set in place in order to prevent these things from happening in the future. But now the fun part, how can you profit? So there are 3 ways. The first one is investing. The fun thing is the market is a very irrational place. One bank collapse and we think, oh, there comes the next financial crisis. People are selling, stocks are falling. But the smart people under us, they can navigate through this fear. It's like Warren Buffett says, buy when everyone is fearful and sell when everyone is greedy. So what your job is not to randomly buy a falling bank, then you're just gambling and playing stupid, but you have to calculate intrinsic value of the bank. If those banks get very, very cheap, pennies on the dollar, then it's time to scale in, buy a position. Just like most bank executives, they were like, oh my God, these stocks are falling, this is goddamn great, it's sales. So they were buying back a lot of their stock. The second option how you can profit is to trade. That's the exact opposite. Sell when everybody is fearful and buy when everybody is greedy. From the moment this news broke, people are fearful, and as a trader, this is something I love to see. I love to see volatility. That is where my profit comes from. If everybody's greedy, if everybody's afraid, okay, let's play. Now, I will be honest with you. I can give you a specific strategy how I would have traded it. But the only 2 days, I took a break from the stock market, the bank is collapsing, and I'm not looking. Unfortunately. And the third way to profit is learn from their mistakes. What do you do in life? In your investment portfolio, in your trading, or any other project you might do in your life, takes lessons from their mistakes. Know if those banks, people who should know it all, if they're prone to human biases, you are as well. Be aware of your normalcy bias. Be aware of your optimistic bias. And be prepared when things don't work out. There are always black swans. There are always unknown things that you don't know that can happen. Take risks, but be prepared to navigate the storm. If you do not want to make the same mistakes that I did, the mistakes that cost me a ton of money, you have to watch this video. You absolutely have to watch this video.